Alright, for this video we want to go over a sample form 990T for the 2023 tax year. This is a filing submitted by tax-exempt organizations that have unrelated business taxable income. So our sample here, John Taxpayer Foundation, this is the second year they're filing this 990T, so I'll put a link below for that first initial year 2022 form 990T if you want to go look at that first. So this is going to be the second year filing based on their investment in a pass-through entity. So we've got the Form 990T here for 2023, which we'll go through. We've also got the K-1 that the foundation received from their investment in that partnership, so we'll cover this as well. And then we do have for reference here the Form 990T from the 2022 tax year. And again, I'll put a link to that video below in the description. And then lastly, we do have one slide here just covering some background on the 990T, who needs to file this, and what our fact pattern looks like. So who needs to file these 990Ts? Generally, it's any kind of tax-exempt organization that has UBTI, right? So unrelated business taxable income, or in certain cases, different types of retirement accounts. So if you have IRAs, 401ks, 529 tuition plans, HSAs even, if these types of accounts, which are generally tax exempt, right? So the earnings in, let's say, a traditional IRA aren't subject to tax on an annual basis. But if you have certain types of investments in those accounts that generate UBTI, you might have to file a 990T. So when do private foundations or other public charities generate UBTI? There's really three main kind of areas where we see this being an issue. So if you're invested in partnerships or S-corps or trusts even, which are pass-through entities, and those pass-through entities have ordinary income flowing through them, that's going to very likely generate UBTI for the tax-exempt private foundation. Another one, which less common but can trip up some tax-exempt orgs, is hedge fund investments. So if they're invested in hedge funds that are passing through interest, dividends, capital gains, those are generally not going to create UBTI, but they will if the hedge fund is using leverage. So if the hedge fund borrows a lot of money to finance those investments, that could generate UBTI for the foundations. And then lastly, there is if it's just flat out conducting its own trade or business. So if you have public charities or private foundations that are selling goods or services for profit, and those activities aren't substantially related to their exempt purpose, that could generate UBTI. All right. Now, some reporting basics and some common deductions here. When we look at the 990T, you'll see that you are able to deduct expenses that are directly connected to that unrelated business. And in some cases, you can allocate indirect expenses to that activity as well. What we see in practice is tax prep fees and other types of taxes, so like foreign taxes, excise taxes, those can be allocated to the unrelated business income. But that's generally all we normally see, unless you're up here on this line item. If you're actually conducting your own business, then you're going to have a lot more deductions, right? You might have cost of goods sold, operating expenses, and things like that. Now, another big one, particularly for private foundations and public charities, are the charitable contribution deductions. So when the foundation actually makes distributions to those public charities, they can deduct a portion of those charitable contributions against your UBTI. Right now, the deduction is limited, so there's a 10% limit on UBTI. We'll look at that computation later on the 990T. And then there is a 5-year carryover. So if you have unused contributions, you can roll those forward for 5 years and then they expire. And then lastly, there is that $1,000 specific deduction. So it's analogous to like a standard deduction or an exemption that you might see on a trust, right? You can deduct $1,000 against your overall UBTI. All right, so let's have a look at the fact pattern, and then we'll look at the return and then some of those work papers. So the 2020 return from last year, the private foundation here invested in Not Real Investment LLC. And let's say this is a Florida-based LLC, taxable as a partnership, which owns and operates parking garages in Florida. So the entity is engaged in the trade of business of operating a parking garage, right? Now the foundation gets a Schedule K-1 for this year, shows line 1, ordinary income, $1,620, and it correctly determines that this is going to be unrelated business income, right? This is not related to the charity's exempt purpose. So in 2023, the foundation distributed $3,000 to public charities in Florida. So those are 501c3 public charities, so that's going to be relevant for purposes of our charitable deduction. And the 990PF and 990T were extended, so they filed extensions. And with the 990T extension on the 8868, they did not include any payments. Now, the reason why they didn't include any payments, because last year they had a federal tax overpayment, which is being carried forward to the current period, right? So they figured they'd have enough paid in as a carry forward, and so they didn't need to make any additional extension payments. And the foundation does have unused charitable contribution carryovers from the prior period. All right, so let's have a look at the return itself and start going through some of these items. So if we start with the K-1 that generated this income, so again, this is the K-1 that they receive. It's a partnership investment. We've got the partner name down here, right? So this is our foundation, John Taxpayer Foundation. It's an exempt organization, and we can see the capital account reconciliation here. They did get an allocation on line 1 of ordinary business income of $1,620. So the $1,620, if we look at their 990PF for the year, we can see that it is being recorded in the net investment income column. So on line 11 there, the other income, the $1,620 of pass-through income from that operation. And so as such, they need to report it on the 990T and then pay taxes on it, right? So we've got the 990T here. It's the 2023 year. Column B, right? How is the entity classified? Under the tax code, it is a 501c3 private non-operating foundation, and organization type is a 501c corporation. You can have 501c3 trusts, right? So if you have a trust set up that filed for the tax exemption, then maybe it'd be a 501c trust. But in our case, this is a corporate entity set up in Florida that applied for that tax exempt status. The end of the year book value of the assets, right? You can pull that number from both your financial statements and the 990PF itself, or if you're doing this for a 990, you would also have that value available as well, just looking at the balance sheet. And then item J, the number of schedules A that we're attaching, so we're going to attach only one. And so if we just jump down to that really quickly, talk about Schedule A bit. So the 990T, pages 1 and 2 are kind of like the totals, and then Schedule A is prepared for each different type of unrelated trade or business. So for each unrelated trade or business you have, you should complete a separate Schedule A, fill out all the fields that are required based on that investment, and then the totals are all summarized up on page 1 here, and then you would check or in item J indicate how many Schedule A's that you're attaching. In our case, we just have the one pass-through entity business, so we only have one Schedule A that's going to be required. So Schedule A, name of the organization, EIN for the organization, and then the type of unrelated business activity. So you can look up the business activity code for what type of business it is that you're invested in, and then describe the business here. If you have income from partnership investments is how we've labeled it here, you could be more precise and perhaps put in investment in parking garages or something to that effect. But generally, when you have pass-through income from K1s, it's appropriate to simply list that it's income from partnership investments. Now, line 5 in part 1, we have the income or loss from partnerships or S-corps. And so on line 5, we've entered the $1,620 that's flowing through from that K1. In part 2, we don't have any deductions that are being claimed. So again, you can see allocations of taxes. So if you have taxes allocated to this type of investment, those are things like excise taxes or foreign taxes that you aren't claiming a credit for. You want to claim it as a foreign tax deduction. You might have those there. And then in line 14, other deductions. Sometimes we see an allocation of the tax prep fees that we use to prepare the 990T. So you can have those listed down there if you want as well. Now the rest of the pages here in Schedule A won't apply for this example, but you can see how in certain circumstances you might need these additional parts. So cost of goods sold, for example, Part 3, we don't have any of this activity, so it's blank. But if you were, if you had like a gift shop or something like that at your charity and you were selling books or other types of materials or supplies that would be inventory, you might have to prepare the cost of goods sold reconciliation. And then the same goes with the rest of the parts too, right? Rental income, we're not renting any property out to individuals or businesses, so we don't have anything like that. We don't have unrelated debt finance income. No interest coming from controlled organizations, right? So none of these elements that apply. Advertising income, if you had a publication or a newsletter and you were trying to sell ads, you might have some UBTI from advertising income. Again, nothing like that for this private foundation. It's probably one of the more basic examples you'll ever see, where the foundation simply just has a K1 from a partnership investment. So we've got our $1,620 there. That flows through, again, because we only have one Schedule A, flows through up to Part 1 for the total amount of unrelated business taxable income. Now on line 4, the charitable contribution, this is, again, the charitable contribution deduction that's available to corporations, but it's limited to 10% of your unrelated business taxable income. So if we have a look at the roll forward, the charitable contribution computation. So we have a statement here showing the charitable contribution calculation that's going on line 4. So that's line 4, page 1 of the 990T. So generally, it's 10% of whatever your taxable income is, your unrelated business taxable income, but it has to be adjusted for certain items first, right? So if you have any NOL carryovers, capital loss carrybacks, you back out those NOL carryovers, add back any capital loss carrybacks, and then you factor this without regard to any kind of contributions, so the charitable contributions, and you don't factor in that $1,000 special deduction either. So we don't have any of those NOLs or capital loss carrybacks, so we can see our basis here is just going to be the $1,620 in the UBTI coming through from that partnership, and the contribution deduction is limited to 10% of that taxable income amount. So $162, which is 10% of the $1,620, is going to be the maximum amount of deduction that we can claim in this year, right? $162. Now, the question is, how much do we have available? So line 6 here of our worksheet, we have $5,870 available. So how do we get that number? Well, the number comprises of the current year charitable contributions. So those are contributions to 501c3 organizations. So if we look at our 990PF here, we have in the disbursements for charitable purposes column D, we did distribute $3,000 to 501c3 public charities. So that's the amount available for this year, and the amount that is carried over from the prior year. So in the prior year, this is the 2022 return. If we jump down to the worksheet from the prior year, we can see that we had also $3,000 available, so they made $3,000 contribution last year, and we used $130 of it. So the carryover for 2022, $3,000 available, we used $130, so $2,870 is being rolled forward to next year, and it's available for 2023. So the $5,870 is two components, right? Again, it's the $3,000 from the current period, right? And then it's also the $2,870, the carryover from the prior year. So we have $5,870 available that we can use, but we're only going to be able to use $162. So if we update our carryover schedule here, we've got the year 2023, $3,000 was available for this year. Again, same as last. Could be different, certainly, depending on your how many contributions you make. The amount we're using for the current period, 162. So the carryover from 2023 is 2838. So next year for 2024, we're carrying over 2870 attributed to 2022 and 2838 attributed to 2023. All right. Now, if we go back up to 990T, so the $162, that's our deduction for the current period. So the total unrelated business taxable income that we're going to be before the special deduction and any kind of NOLs is $1,458. So we get our $1,000 specific deduction there. So our net unrelated business taxable income is $458 for the period. Now, the tax, because this is basically a corporate tax, the tax is simply just the 21% times the net amount. 21%, that's the new corporate rate that was put into place post-2017. Could change, right? If you're watching this in a future year, maybe the rates have changed. But for 2023, it's 21%. So $96 is the amount of tax that we owe on our net unrelated business taxable income. Now, as far as the tax and payments reconciliation, if we look here, the payments, remember, we didn't make any estimated payments. We didn't make any payments with an extension. We just rolled forward the payments, the overpayment from the prior year. So if we look at the prior year, so in the prior year, our taxes were $36. We made an extension payment, $500. So the overpayment was $464. This is the 2022 return. So the amount we wanted refunded was $0, and we elected to roll all of it. So credit all of it to the 2023 estimated tax. So $464 is available to us for 2023. So we've got the payments, preceding year's overpayment, credited to the current year, $464. And so if we just do some simple math here, right, we owe $96, we have $464 available to cover it. And so now the net amount remaining is $368. And we're going to do the same thing we did last year. We're not going to have any of it refunded. We're just going to credit all of it to 2024. And so when we do our 2024 Form 990T, we'll pick up this overpayment on that return. Now, last item here is part 4. Other activities, certain activities and other information. So pretty straightforward here for this one this example, right? We don't have any foreign bank accounts, so no for foreign bank accounts. We're not filing any FBARs. We didn't receive any distributions, nor were we the grantor of creating a foreign trust, so no there. And no tax-exempt interest received during the year, no NOL carryovers. Right, so all of these items are blank. We just answered questions 1 and 2 as no. All right, so that covers it for this tutorial. I hope that was helpful. If you have any questions, please leave a comment below. I tried to get to as many of those as I can. And I look forward to seeing you again on the next video. Thank you.